May 25, 2026 Real estate market news. Billion-dollar merger, bidding wars and office crisis. Disclaimer: this in-depth report is for informational purposes only. It does not constitute legal, medical, financial, or official advice. All content is presented as news and analysis, not as any form of personal advice, and any anecdotal references are illustrative only, not guidance. Consult licensed professionals for advice on legal, financial, or health decisions. 1. Apartment REIT mega merger creates $69 billion rental housing giant. Confidence in multifamily soars. The Real Estate Investment Trust, REIT, sector witnessed a historic consolidation as AvalonBay Communities and Equity Residential announced a merger of equals to form the largest U.S. apartment REIT to date. This all-stock deal, valued at approximately $69 billion, will unite two of the country's leading publicly traded apartment landlords. It will combine more than 180,000 rental units under a single company spanning dozens of major markets nationwide. Under the terms of the agreement, AvalonBay's stockholders will receive roughly 2.8 shares of Equity Residential for each AvalonBay share, leaving AvalonBay's investors owning just over half, about 51%, of the combined firm once the transaction closes, with Equity Residential's investors holding the remainder. Analysts have described the merger as creating a rental housing behemoth and note it ranks among the largest REIT deals ever recorded, signaling strong confidence in multifamily housing as a resilient asset class despite recent economic uncertainties. Once complete, the combined REIT will operate a portfolio in more than a dozen major U.S. metropolitan areas, firmly establishing itself as a national leader in the apartment market. The companies have highlighted their overlapping presence in high-demand urban and suburban markets as a key strategic advantage, expecting that an integrated operating platform and economies of scale will yield at least $175 million in cost synergies within 18 months of closing, potentially boosting earnings per share. Executives project that streamlining property management and overhead will indeed achieve those synergies on schedule, adding measurably to the bottom line of the new company. They also emphasize that the expanded company's scale and combined expertise will allow more aggressive investment in advanced property technology and efficiency measures. Furthermore, leadership intends to maintain a robust development pipeline of new apartment projects to capture growth opportunities in core markets. This optimistic outlook underscores management's belief that the merged company will be better positioned to weather economic cycles with greater resilience. In the wake of this blockbuster merger, industry observers say it could spark a broader wave of real estate consolidation as firms seek greater scale and efficiencies. The multifamily sector has weathered economic swings better than many other property types in recent years, and larger players appear increasingly interested in strategic partnerships or acquisitions to further strengthen their portfolios. Analysts are already pointing to other potential deals among mid-sized apartment REITs and private equity-backed rental housing operators, noting that the newly merged AvalonBay Equity Residential Colossus may pressure peers to expand or combine to remain competitive. Some expect that well-capitalized investors will scoop up smaller rivals or distressed portfolios, especially as interest rates stabilize, in a bid to achieve the kind of operational cost advantages promised by this deal. Meanwhile, policymakers and tenants advocates are closely watching how consolidation might affect rental markets. The new combined company could bring more resources to improving properties and building new units. But there are also concerns that reduced competition could lead to higher rents in some already expensive cities. All eyes are now on how regulators respond. Early indications suggest that because the company's holdings overlap widely but do not dominate any single market, the merger is likely to proceed after standard antitrust review, setting the stage for a transformed landscape in U.S. rental housing. Subtopic 1. Real estate investors are amassing unprecedented capital to deploy into property markets, highlighting sustained confidence even amid recent volatility. Leading private equity firms and institutional funds have raised record-sized real estate vehicles over the past year, eager to snap up undervalued assets and back large deals such as the AvalonBay Equity residential merger. For example, Blackstone recently closed a new global real estate fund nearing $50 billion, one of the industry's largest ever, signaling that major investors are positioning themselves to acquire properties and portfolios that emerge at attractive prices. These dry powder war chests indicate that capital markets still view real estate as a compelling investment, especially now that valuations have adjusted downward from their peak and interest rates appear to be stabilizing. Many opportunistic investors see the current period as a chance to capitalize on distress or consolidation plays, whether it be taking over underperforming office towers for redevelopment or buying stakes in promising multifamily projects that need fresh funding. This influx of capital could help support asset prices and facilitate transactions, potentially cushioning the real estate sector from a deeper slump. However, market experts caution that this capital will be deployed selectively. Investors remain discerning about property types and locations and are demanding higher returns to compensate for still elevated economic uncertainty. 2. Interest rates plateau and credit conditions ease. Fed pause brings stability for borrowers. A significant tailwind aiding the real estate sector is the newfound stability in interest rates following the Federal Reserve's decision to pause further rate hikes as inflation pressures moderate. Entering the second quarter of 2026, the U.S. Central Bank has held its benchmark rate steady after an aggressive tightening cycle in the prior years, signaling that borrowing costs may have peaked or are near their peak for this cycle. As a result, yields across bond markets have settled and mortgage rates have plateaued after experiencing volatility earlier in the year. The average 30-year fixed mortgage rate, which spiked above 7% during recent turbulence, is now hovering in the mid-6% range, around 6.4%, providing more predictability for homebuyers and commercial investors planning financing. The brief surge in rates in March, driven in part by global market jitters over a short-lived conflict in the Middle East, has subsided, and economists note that the Fed's steady stance and hints of a possible pivot to rate cuts in late 2026 have calmed credit markets. This backdrop has begun to ease financial pressures on real estate, as stable or gently declining interest rates reduce the headwinds on property values and debt costs that were so acute during the earlier rapid tightening phase. Lenders and financial institutions are cautiously loosening some lending criteria now that the rate environment is calmer, reversing the severe credit tightening seen in late 2024 and 2025, when rising borrowing costs and a few high-profile bank failures sparked fears of a real estate credit crunch. With inflation gradually retreating toward target levels and the outlook for monetary policy more predictable, banks and investors report a slow but steady uptick in financing availability for qualified real estate projects and buyers. Commercial banks, which had pulled back on real estate lending after their capital reserves were stressed during the 2025 interest rate spike, are selectively re-entering the market, often focusing on lower-risk loans or partnering with other lenders to share exposure. The Mortgage Bankers Association notes that new mortgage applications for both home purchases and refinancing have started to recover from their wartime dip, reflecting borrowers' renewed confidence that interest rates will remain comparatively stable or even ease later in the year. However, credit conditions remain bifurcated. Top-tier borrowers and projects are finding funds at reasonable rates as competition among lenders returns, while more marginal deals, such as speculative commercial developments or heavily leveraged buyers, still face high scrutiny and elevated financing costs, a legacy of the cautious mood that took hold during the prior tightening phase. The pause in rate hikes has not only stabilized borrowing costs, but also lowered the likelihood of a sharp economic downturn, another positive for property markets. By indicating a willingness to support growth if needed and to keep credit flowing, central bankers have helped restore confidence among developers, investors, and homebuyers who had been unnerved by rising interest expenses and recession fears. With monetary policy headwinds abating for now, real estate professionals are hopeful that capital markets will continue to thaw, allowing stalled projects to move forward and boosting transaction volumes for both residential and commercial properties. Yet some uncertainty persists. Any reacceleration in inflation or other economic shock could force the Fed to reconsider its stance and tighten policy once more, an outcome that would again challenge real estate valuations and leverage. Market watchers will pay close attention to each economic data release and Fed official speech, hoping for clear confirmation that policymakers feel their anti-inflation work is done. For the time being, though, the real estate sector is benefiting from the relative calm in interest rates, a welcome respite after years of volatility. Subtopic 2. The prolonged period of elevated interest rates has prompted borrowers and lenders alike to embrace creative financing strategies to make deals pencil out and to bring more buyers into the market. One notable trend is the resurgence of adjustable-rate mortgages, ARMs, and other non-traditional loan products among homebuyers eager to secure lower initial interest costs. With fixed mortgage rates still around the mid-6% level, ARMs, which often start with rates nearly a full percentage point lower, have grown in popularity, now comprising a significantly higher share of new home loan originations than in past years. Lenders are also offering buydowns and other incentives. Some homebuilders and sellers are paying upfront to temporarily lower buyers' interest rates in the first few years of homeownership, easing initial payment burdens. Additionally, new products such as 40-year mortgages and shared equity financing arrangements have emerged, targeting first-time buyers squeezed by both high home prices and elevated borrowing costs. These longer-term and shared risk options promise more affordable monthly payments in exchange for either a longer payoff horizon or giving up some future home price appreciation to outside partners. The expanding array of financing alternatives underscores how the industry is adjusting to a higher rate environment, but experts caution consumers to fully understand these products' terms. Lower early payments can come with trade-offs like greater total interest or reduced equity, so borrowers should weigh these choices carefully. Still, this flurry of innovation reveals a collective effort to bridge the affordability gap and keep the home buying pipeline flowing even as traditional mortgages remain historically expensive. 3. Spring brings housing market rebound, buyer demand and home sales surge. After a tepid 2025, the U.S. housing market is showing renewed vitality this spring, with buyers returning in force and home sales accelerating across many regions. According to the National Association of Realtors, NAR, existing home sales have risen for several consecutive months, and pending home sales, a forward-looking indicator based on signed contracts, are up approximately 8% from a year ago. This is the first year-over-year gain in pending home sales since the height of the 2022 slowdown, suggesting the housing market has turned a corner. The improvement has been particularly evident since March, when worries about a Middle East conflict briefly rattled financial markets and nudged mortgage rates higher. With that conflict now de-escalating and mortgage rates stabilizing, prospective buyers who had been waiting on the sidelines through winter are moving ahead with purchases. Realtors across the country report a noticeable uptick in open house foot traffic and multiple offer situations on well-priced listings as pent-up demand, a strong labor market, and a sense that the worst of inflation and rate hikes are behind us have combined to re-energize home buyers. Home prices, which saw modest declines in many areas last year due to the affordability squeeze, have largely stabilized and are even inching back up in the markets where demand is hottest. The national median existing home price in April 2026 was roughly flat compared to a year earlier, at about $376,000, halting a slide that occurred in late 2024 and early 2025. In some regions where supply remains extraordinarily tight, prices are trending upward again. For example, parts of the Northeast and Midwest have seen single-digit percentage increases in median prices over the past quarter following earlier dips. This resilient pricing is partly a function of the continued shortage of homes for sale. By many measures, inventory remains well below healthy levels. The nationwide supply of homes on the market is only about 3 months at the current sales pace, far short of the 5 to 6 months that typically indicate a balanced market. Many homeowners who locked in ultra-low mortgage rates in prior years are still reluctant to sell and give up those rates, keeping resale inventory scarce. That has translated into stiff competition for the relatively limited number of homes available, helping to prevent further price declines even during last year's market lull, and now contributing to upward pressure on values in places where buyer activity has jumped. The atmosphere in spring 2026 is reminiscent of the red-hot housing frenzy of the late 2010s, albeit at a somewhat cooler temperature overall. In desirable suburban neighborhoods and fast-growing mid-sized cities, sellers are once again fielding multiple offers, and the average time a home spends on the market has shortened noticeably since the start of the year. This turnaround comes after a period when many markets favored buyers or at least offered more balance. Now, as demand picks up without a commensurate flood of new listings, bargaining power is tilting back towards sellers in numerous locales. Real estate agents indicate that well-priced, move-in-ready homes often attract heavy interest and even bidding wars, especially at moderate price points popular with first-time buyers. Housing affordability remains a challenge, with mortgage costs still elevated compared to a few years ago, but gradually rising wages and a small retreat in home prices from their peak have slightly improved the equation for many families. Because of this newfound momentum, several forecasters have upgraded their outlook for the housing market in 2026. Instead of another year of contraction or stagnation, they now anticipate modest growth in total home sales and potentially a return to nationwide home price appreciation by year's end, barring any new economic shocks. Subtopic 3. In an echo of the market frenzy seen a few years ago, certain local housing markets are once again experiencing feverish bidding wars and above-asking sales, underscoring the depth of pent-up demand. One recent example comes from suburban New Jersey, where a modest three-bedroom home listed at $499,000 this spring attracted 28 offers within a week, ultimately selling for over $600,000, more than 20% above its asking price. The listing agent described frenzied showings, with dozens of prospective buyers crowding open houses despite the property's unassuming size and need for some updates. Many bidders were first-time buyers armed with lender pre-approvals and determination after losing out on other homes, indicating how strong demand remains relative to supply. Similar stories have emerged in other pockets around the country. A starter home in a Denver suburb drew more than a dozen offers and was bid up $75,000 beyond list price. A townhome in a popular Atlanta neighborhood sold in just 2 days after sparking a bidding contest. These instances show that even with higher interest rates than in past booms, sufficiently attractive and scarce homes can generate intense competition as buyers jockey for limited options. Analysts caution that such episodes are not yet the norm in every market. Many areas still see more measured activity, but they highlight how quickly competition can reignite when conditions favor sellers and illustrate the pent-up demand among those determined to become homeowners after waiting out last year's slowdown. 4. Rental market diverges. Coastal city rents surge while Sun Belt rents cool. The U.S. rental housing market in 2026 is telling two very different stories depending on the region. In high-cost coastal cities that experienced an exodus and rent declines during the pandemic, demand has roared back, sending rents sharply upward over the past year. For instance, average apartment rents in San Francisco, Seattle, and Manhattan have jumped by double-digit percentages year over year, with San Francisco's median rent now nearly 20% higher than a year ago. A renewed influx of young professionals and tech workers, many being called back to offices or drawn by resurgent urban amenities, is colliding with a relatively static supply of rental units in these cities, driving fierce competition for apartments and enabling landlords to raise asking rates significantly. On the flip side, in a number of Sun Belt markets that boomed earlier when remote work and migration patterns favored them, rent growth has not only slowed, but reversed slightly as a wave of new apartment construction hits the market. Cities such as Phoenix, Austin, and Atlanta, which saw a frenzied building spree in recent years to accommodate rapid population growth, are now contending with higher vacancy rates and modest rent declines of about 4% to 7% in some overbuilt submarkets. This regional divergence underscores that the national rental market is far from monolithic. Local supply-demand dynamics are dictating vastly different outcomes across the country. On a national scale, rents have edged up modestly in recent months, but that broad average conceals considerable variability. According to the latest Zillow Observed Rent Index and other industry measures, U.S. median rents are up roughly 2% year-over-year, a stark contrast to the nearly 20% national rent surge seen at the pandemic's height, but still a positive growth rate overall. That slight national increase belies extremes across locales. Some coastal urban cores are witnessing the fastest rent inflation in years, while a few previously overheated Sunbelt metros now have more apartments available than renters to fill them. In markets like Miami and Dallas, rents have largely plateaued as new supply catches up with the earlier demand surge, whereas older, high-priced markets like Boston and Los Angeles have regained enough momentum and in-migration that tight inventories are pushing rents upward again, though not as dramatically as in San Francisco. Additionally, many smaller cities and suburban areas that saw rents skyrocket in 2021 to 2022 have settled back into equilibrium. Their rent levels have come off the peak as new multifamily projects complete, giving tenants slightly more bargaining power than during the frenzy days. Landlords nationwide are still benefiting from generally high occupancy. The national apartment occupancy rate remains close to 95%, but some are starting to offer concessions like a free month's rent in oversupplied locales, while others in supply-constrained cities continue to enjoy bidding wars for their units. Another factor in the cooling of some markets has been the gradual normalization of migration patterns and return-to-office policies. During 2021 to 2022, a mass migration into Sun Belt and Mountain West locales sent rents soaring in places like Tampa and Boise, but those influxes have since tapered off. And some workers who moved are trickling back to coastal employment centers or not relocating at the same pace as before. At the same time, major employers' decisions to end fully remote arrangements and mandate hybrid schedules have increased the appeal of being closer to central offices again, benefiting the rental markets of New York, San Francisco, and other coastal job hubs that had lost population. Technology and finance companies in particular have been bringing employees back at least a few days a week, spurring many staffers who left expensive cities to reconsider their moves and new hires to relocate in. The upshot is that demand is redistributing. Previously red-hot smaller markets are catching their breath as supply rises, whereas the big coastal cities, after years of net outmigration and soft rents, find themselves undersupplied in rental housing, leading to a sudden upward rent correction. Economists foresee these divergent trends continuing in the near term, though eventually much of the newly built Sun Belt housing will get absorbed as those regional economies keep growing. And coastal rent growth is expected to moderate as it bumps against affordability ceilings and potential new construction or policy measures on the horizon. Subtopic 4. San Francisco's rental market provides a vivid case study of the steep rebound in demand for urban housing after earlier pandemic-era declines. Over the past year, San Francisco's typical apartment rents have surged nearly 20%, a rebound few would have predicted when the city's rental market was in a deep slump in 2021 to 2022. Tech companies that once embraced fully remote work have increasingly pivoted to hybrid schedules, and a buzzing resurgence of the city's cultural and social life has drawn many remote workers back to the Bay Area, reviving neighborhoods that had emptied out. Vacancy rates in San Francisco have plunged as a result, from double-digit percentages in 2021 to roughly 5% now, close to the city's pre-pandemic norm, giving landlords much greater pricing power than in the recent past. Renters returning to the city or moving in for new jobs face a far tougher market. Bidding wars for desirable rental units have reappeared, and it is not uncommon for landlords to field multiple applications or even higher than listed rent offers from eager prospective tenants. At the same time, construction of new apartments in San Francisco has not kept up with renewed demand, partly because high development costs and regulatory hurdles make building difficult and slow. This constrained supply, combined with tenants flooding back, has propelled sharp rent increases, reversing a period when many landlords were offering discounts or free months to fill units. While a nearly 20% annual jump pushes San Francisco rents back toward their previous peaks, the trend is intensifying an affordability crunch in an already expensive city, putting local officials under pressure to enact additional housing initiatives and tenant protections. 5. Builders boost construction amid shortage. Home building ramps up to meet demand. Home builders across the United States have swung into action this year, accelerating construction activity to capitalize on the housing rebound and persistent inventory shortages. The latest government data show that both housing starts and building permits, key measures of new residential construction, have climbed significantly compared to a year ago, even accounting for a temporary pause during the uncertainty of early spring. In April, total housing starts reached an annualized rate of approximately 1.5 million units, up from roughly 1.35 million in the same month last year, a pace not seen since before the Federal Reserve's rapid rate hikes began slowing the market. Builders are especially focused on segments where supply is scarcest. Single-family home starts have ticked upward as growing numbers of first-time and move-up buyers re-enter the market, while multifamily construction remains robust to satisfy strong rental demand in many regions. Industry confidence metrics reflect this momentum. The NAB Builder Sentiment Index recently rose above the neutral 50 level for the first time in over a year, indicating that more builders now view conditions as good rather than poor. Although financing costs for developers remain higher than during the ultra-low-rate era, the steadiness of rates and signs of revived buyer interest have spurred many firms to break ground on new projects they had previously delayed. Another factor aiding the building boom is the gradual easing of supply chain bottlenecks and input costs that had plagued the industry over the past few years. Prices for lumber and certain other key materials have receded significantly from their pandemic peaks. Lumber costs today are roughly half of what they were at the height of 2021's frenzy, and the availability of appliances, windows, and other finished materials has improved, reducing the delays and unpredictability builders faced during the worst of the supply disruptions. Labor, however, remains a tight spot. Skilled construction workers are still in short supply, and builders in some areas report difficulty hiring enough crews to expand production as quickly as demand would dictate. Nonetheless, large national home builders have been increasingly successful at attracting labor and streamlining operations through off-site prefabrication and other efficiencies to mitigate the labor crunch. They are also targeting product mixes that align with market needs. For instance, many builders are pivoting to slightly smaller and more affordable single-family homes or constructing more townhouses to appeal to budget-conscious buyers who have been shut out of the existing home market. Additionally, increased interest in build-to-rent subdivisions, where houses are constructed specifically as rental properties, has provided a new avenue for homebuilders to deploy capital, supported by investor groups hungry for stable rental assets. Despite the encouraging increase in building activity, the United States still faces an enormous housing supply gap that will require prolonged, large-scale development to close. Economists estimate the nation remains several million housing units short of what is needed to fully meet demand, the result of a decade of underbuilding after the 2008 financial crisis and accelerated household formation in recent years. Recognizing that this shortfall has driven up housing costs, policymakers at various levels have introduced measures to support new construction. The federal government, for example, has proposed expanding tax credits for low-income housing development and offering incentives to localities that reform restrictive zoning laws impeding multifamily projects. Some state governments are stepping in too. States like California and Montana have passed laws in the last 2 years to spur more housing by overriding local rules that limit density or by easing permitting processes for accessory dwelling units and subdivisions. These moves are intended to complement the market's momentum, encouraging builders to maintain higher construction volumes even if economic conditions fluctuate. The hope is to steadily chip away at the housing deficit, which should eventually cool price and rent growth by bringing supply closer to demand. Still, industry leaders counsel patience. Building at the scale required will take years, and challenges from land availability to skilled labor will continue to constrain how fast new inventory can appear, meaning the affordability crisis will remain a long-term challenge. Subtopic 5. The Sun Belt continues to be America's hotbed of home construction, as booming metro areas in the South and Southwest lead the nation in building activity. Texas and Florida, in particular, stand out for their rapid pace of housing starts. Cities like Dallas-Fort Worth, Houston, and Tampa consistently rank among the top metros for new home development. Fueled by steady population influx, plentiful land, and pro-growth local policies, these regions have seen double-digit percentage increases in home construction year over year. In Phoenix and Nashville, the skyline of new subdivisions and apartment complexes under construction reflects local economies that remain magnets for job seekers and retirees alike. Builders are drawn to these Sunbelt markets not only by robust demand, but also by comparatively lower regulatory hurdles and costs than in coastal states. The abundance of new homes in some Sunbelt cities is already moderating price gains, offering a template for how increasing supply can tame housing inflation. However, even as the Sunbelt leads in adding housing units, rising labor and material costs mean that truly affordable housing still lags behind the need in many communities. And the building spree in warm weather states shows little sign of abating so long as households continue migrating for jobs, lower cost of living, and warmer climates. 6. Tech transformation in real estate. PropTech innovations and smart buildings on the rise. From artificial intelligence-driven pricing algorithms to sensor-laden, smart buildings, technology is permeating every corner of the real estate industry, transforming how properties are bought, sold, and managed. A recent survey by a major real estate services firm found that more than 70% of large commercial property owners have now implemented some form of advanced smart building system, such as connected HVAC, lighting, and security controls, in at least part of their portfolios. The drive to improve energy efficiency, tenant comfort, and operational data analytics has propelled significant investments in building technology. In office towers and apartment complexes alike, owners are installing Internet of Things (IoT) networks of sensors to monitor everything from temperature to foot traffic, using the data to optimize building performance and cut costs. Not only do these technologies create greener, more cost-effective properties, they also increasingly appeal to tenants who are demanding modern, high-tech amenities in the spaces they lease. These smart systems became even more important over the past few years as building managers sought to enhance air filtration and touchless controls during the pandemic, and that momentum has continued, with property companies often touting their smart building credentials as a competitive advantage in attracting occupants. The residential side of real estate is also being reshaped by technology, particularly in how homes are bought and sold. Major online real estate platforms have rolled out new artificial intelligence tools to provide more accurate home value estimates and to help match buyers with properties more efficiently. Zillow, for instance, recently deployed an AI-driven home valuation model that it claims is significantly more precise at predicting sale prices in fast-moving markets compared to prior algorithms, potentially increasing transparency for both buyers and sellers setting listing prices. Some brokerages are using predictive analytics to identify likely sellers among homeowners, allowing agents to reach out proactively, while others have introduced virtual assistants that use natural language processing to answer questions from home shoppers in real time. Virtual and augmented reality home tours have become commonplace. Prospective buyers can now explore 3D digital models of properties from their living rooms, and some agents are experimenting with augmented reality staging apps that let users visualize different furniture or renovations. Meanwhile, the mortgage industry is experiencing its own digital wave. More lenders are adopting end-to-end online application portals, automated income and asset verification, and even blockchain-based transaction tracking, all aimed at reducing paperwork and speeding up closings. Industry experts note that real estate historically lagged other sectors in technological adoption, but now the PropTech sector is booming with startups and venture funding, driving a rapid modernization across real estate transactions and property management that is fundamentally changing how the business operates. Real estate technology is not without its challenges and controversies. The increased reliance on algorithmic valuations and digital platforms has raised concerns about data privacy, algorithmic bias, and cybersecurity. Some housing advocates worry that AI pricing tools might inadvertently perpetuate biases or inflate prices in certain markets by reflecting past inequities or over-optimism. Additionally, as more transactions move online, the industry has had to bolster defenses against cyber threats, such as wire fraud schemes targeting digital home closings and breaches of sensitive financial data. Still, on balance, the push for innovation carries significant promise and continues unabated due to the efficiencies and improved experiences it offers. Property investors, for example, are now leveraging big data analytics to spot market trends and make portfolio decisions faster, tasks that were manual and slow just a decade ago. Real estate professionals are upskilling to incorporate these tools, whether by learning to interpret analytics from a smart building's energy dashboard or mastering a suite of AI-enhanced marketing software to better target customers. As the technology evolves, the expectation is that real estate will become more transparent, accessible, and efficient for everyone involved, even as the industry navigates how to manage the risks and ensure these innovations truly benefit end users. Subtopic 6. A new gadget called the Smart Lockbox Pro has become a viral sensation in real estate circles, illustrating the growing appetite for practical technology that streamlines home buying. Essentially a high-tech upgrade to the classic Realtor lockbox, this Bluetooth-enabled device garnered widespread attention on social media for its ability to let agents and verified buyers unlock a property's door remotely via a smartphone app. The Smart Lockbox Pro integrates one-time access codes with biometric verification, meaning homeowners or listing agents can grant prospective buyers entry to view a home on their own schedule while still maintaining strict security and a detailed log of every visit. Videos demonstrating the lockbox's convenience, for instance, showing how a buyer running late can reschedule a showing without an agent present, have racked up millions of views on TikTok and Instagram among real estate enthusiasts. By combining robust encryption with user-friendly design, the gadget aims to solve a persistent friction point in home sales, coordinating in-person viewings. After its viral moment, the manufacturer reported a surge in orders from brokerages nationwide, and some large real estate firms are now piloting the device in dozens of listings. While some traditional agents expressed initial skepticism, many are warming to the lockbox as it proves its reliability and potential to make showings more flexible for both buyers and sellers. The device's swift rise from niche tool to social media star underscores how even the long-standing rituals of real estate, like handing over keys for a showing, are being transformed by innovative tech, one Bluetooth click at a time. 7. Office real estate faces reckoning. Remote work and refinancing challenges append the sector. The office sector continues to grapple with an unprecedented crisis as remote and hybrid work arrangements become entrenched and property owners face a wave of debt coming due in a high-interest rate environment. Nationally, office vacancy rates have climbed to record highs, hovering around 20% overall, with central business district offices in some major cities faring even worse. In downtown San Francisco, for example, nearly one-third of office space sits empty, a stark change from pre-pandemic days when vacancy in that tech hub was in the low single digits. Other cities such as Chicago and Los Angeles are also contending with office vacancy rates in the 20 to 25% range, fueled by companies downsizing their footprints as employees spend fewer days in the office or work fully remotely. This demand shock has been most pronounced for older, less amenity-rich office properties that struggle to attract tenants in the age of flexible work. The result is a widening gulf between modern, top-of-the-line office towers, which, while not immune to downsizing, are still drawing tenants with high-end amenities and prime locations, and aging commodity office buildings that often see entire floors sitting empty and their market values sharply reduced. The financial ramifications of this office upheaval are severe, rippling through landlords, lenders, and city budgets alike. Many office building owners are struggling to refinance maturing loans as property valuations have plummeted and banks grow increasingly wary of the sector. A substantial volume of commercial mortgages tied to office properties is set to mature over the next 2 years, and owners face a daunting scenario. Refinancing at much higher interest rates and lower appraised values means significantly higher debt service costs, often beyond what current rental incomes can support. Some high-profile landlords have already defaulted or simply walked away from their buildings, deciding it is better to surrender a property than continue operating it with an unsustainable loan. Even conservative institutional owners are writing down the value of their office portfolios by large percentages, acknowledging the market reality. There is also a broader economic impact, particularly in cities reliant on office worker foot traffic. As office towers empty out, downtown shops and restaurants see fewer customers, and property tax revenues in some municipalities are under pressure due to falling office building values. Credit rating agencies have flagged central city offices as an area to watch for potential financial instability, although thus far banks and investors appear to be weathering the storm, in part because other segments of commercial real estate, like apartments and industrial warehouses, remain comparatively healthy. In response to the office sector's challenges, owners and local governments are exploring creative ways to repurpose or revive underused buildings. One increasingly popular strategy is converting vacant offices to alternative uses, especially housing. In cities from New York to Calgary, municipal leaders have introduced tax breaks and grants to encourage developers to turn older office towers into apartments or condominiums, hoping to tackle both the office glut and housing shortages at once. However, such conversions can be technically and financially complicated. Not every office building is easily turned into residences due to floor plate sizes or a lack of operable windows. So realistically, only a fraction of outdated buildings may be viable for conversion. Other owners are investing to make their offices more appealing in the hybrid era. They are adding contemporary amenities like fitness centers, outdoor terraces, flexible co-working areas, and improved ventilation, or even offering reduced rents to attract new types of tenants such as life science labs, educational institutions, or healthcare providers. Urban planners are also reimagining downtown districts with fewer dedicated office buildings and more mixed-use developments that blend work, living, and entertainment spaces to keep city centers vibrant. It's clear the office sector's old normal isn't returning in full. What emerges will likely be a leaner office market oriented toward high-quality space and creative reuse of obsolete buildings, but the transition may take years. And in the interim, the sector will continue to be one of real estate's largest trouble spots. Subtopic 7. In a telling sign of the sector's plight, a landmark office tower in downtown San Francisco recently sold at a stunningly low price, underscoring the plunge in values for underutilized buildings. The 22-story high-rise at 350 California Street, once a prestigious address in the heart of the financial district, was auctioned off by its lender after the previous owner defaulted, and the winning bid came in around 80% below the building's appraised value just a few years ago. This fire sale transaction saw the tower, which had struggled with high vacancies as tenants downsized, change hands for roughly $60 million, despite being valued near $300 million before the pandemic. The extreme discount highlights how dramatically remote work has eroded demand for certain office assets. The building's older design and less desirable location left it ill-equipped to compete for a now limited pool of tenants, leading to a spiral of vacant space and falling rents that ultimately made the original loan unsustainable. Local officials reacted with dismay at the deeply discounted sale, worried it could set a painful benchmark for other downtown properties and further erode the city's tax base. At the same time, opportunistic investors saw a chance to reposition the building, perhaps converting it to mixed use or redesigning it to attract new kinds of tenants. Whatever the outcome, the case of 350 California Street stands as a dramatic example of the office sector's upheaval, a trophy building trading at pennies on the dollar as the industry grapples with one of the greatest challenges in its history. 8. Industrial real estate remains a bright spot. Warehouse demand and data center growth drive low vacancies. Even as some parts of real estate struggle, the industrial sector continues to thrive. Warehouse and logistics properties have been an unequivocal success story, fueled by sustained expansion of e-commerce, a reconfiguration of supply chains, and a manufacturing uptick in certain regions. Across much of the country, industrial vacancy rates remain historically low, often in the mid-single digits, and rents for modern logistics facilities have climbed steadily over the past year, albeit at a slower pace than the explosive growth seen earlier in the post-pandemic boom. Companies large and small are still racing to secure distribution space that allows them to fulfill online orders quickly and efficiently, leading to bidding contests for warehouses in supply-constrained markets near ports and major cities. This robust demand has been particularly evident in Southern California's Inland Empire, Central Pennsylvania's logistics corridor, and parts of Texas and Georgia, where many warehouses are running near full occupancy within weeks of completion. Industrial developers are responding by delivering more product. New construction of warehouses and fulfillment centers remains strong, and although rising interest rates have injected some caution, many projects still pencil out thanks to high tenant interest and rents that justify current development costs. The broad health of the warehouse segment has also helped shore up the real estate sector's overall performance during recent economic uncertainty, providing steady income for investors and offsetting weaknesses in other property types. One distinguishing feature of the current industrial boom is its expansion beyond traditional warehouses into specialized facilities. The growth of cloud computing and artificial intelligence is fueling an unprecedented need for data centers, giant facilities that house servers and network infrastructure, and markets like Northern Virginia, Phoenix, and Dallas are seeing a surge of new data center development to serve the digital economy's soaring processing and storage demands. Similarly, cold storage warehouses, designed to keep food and pharmaceuticals refrigerated, are in high demand with the rise of online grocery and medical deliveries, and these specialized facilities tend to command premium rents and long leases. These niche segments require significant capital investment and technical expertise, but they also draw strong interest from developers and investors given their high growth trajectories and stable tenant bases. As these specialized uses flourish alongside traditional distribution centers, they diversify the industrial sector's demand drivers and further bolster the overall performance of industrial real estate. Industrial-focused REITs have so far in 2026 reported solid earnings and near-record occupancy and remain among the best-performing companies in the REIT universe. For example, Prologis, the world's largest owner of warehouses, recently announced that its global portfolio is almost fully leased and that it has a robust pipeline of new logistics parks already largely pre-leased in anticipation of continued demand. Analysts believe the industrial sector's long-term leases and critical role in modern supply chains will help it stay resilient even if broader economic growth slows. So long as digital commerce and data usage continue their secular expansion, the industrial segment should maintain its strength, providing stability for investors and mitigating weakness in other areas of commercial real estate. For now, the unwavering appetite for industrial space suggests that warehouses, distribution centers, and specialized facilities will remain a cornerstone of the post-pandemic real estate landscape. 9. Retail and hospitality revive as consumers return. Stores and hotels enjoy post-pandemic resurgence. Long the subject of gloom due to e-commerce competition and travel disruptions, the retail and hospitality sectors are now mounting an impressive recovery as consumer behavior normalizes. Physical retail stores, which endured waves of closures during the pandemic and preceding years, are benefiting from a renewed public appetite for in-person shopping experiences. National retail vacancy rates have been ticking down over the past 2 years and now stand at their lowest levels since around 2015. Notably, more brick-and-mortar stores opened than closed during both 2025 and the first part of 2026, reflecting expansions by discount chains, home improvement retailers, and even some digitally native brands opening physical outlets. Shoppers, hungry for real-life experiences after periods of isolation, have been flocking to malls, shopping centers, and downtown retail districts, boosting foot traffic for tenants and driving up year-over-year sales. Mall operators report that even with fewer department stores anchoring malls than a decade ago, Inline tenants like restaurants, entertainment venues, and specialty retailers are drawing steady crowds. Higher-end open-air lifestyle centers in particular have approached full occupancy as retailers gravitate toward vibrant, mixed-use settings to complement their online presence. While the retail industry still faces long-term questions, such as how to repurpose large vacant big-box stores in older strip malls, the current trend indicates a stabilizing, if not thriving, environment for many retail landlords compared to the dire predictions of a few years ago. The hospitality side of real estate is experiencing a parallel rebound thanks to the robust return of travel. Hotel occupancy across the United States has climbed back to roughly 2019 levels, with leisure travel especially strong and business travel gradually recovering. Tourism in major cities and resort destinations has surged as both domestic travelers and international visitors, finally free from travel restrictions, embark on long-delayed trips. This has translated into significantly higher average daily rates, ADR, and revenue per available room, RevPAR, for hotels relative to last year, improving hotel property valuations and spurring renovations and new development projects. Markets such as Las Vegas, Orlando, and New York are seeing not only full hotels on weekends, but also improved midweek business travel occupancy as conventions and corporate events resume in earnest. Similarly, more store openings than closings have begun to create demand for previously empty retail spaces, and major hospitality REITs report that their occupancies and revenues are rising along with the travel surge. At the same time, the short-term rental segment, via platforms like Airbnb, has matured into a stable part of the lodging industry. In some popular destinations, local regulations have tightened on short-term rentals, pushing more travelers back toward traditional hotels, another factor bolstering hotel performance. In some downtown areas where older offices are struggling, owners have started repurposing vacant floors into boutique hotels, restaurants, or entertainment venues, taking advantage of the retail and hospitality revival to breathe new life into underused buildings. In the suburbs, several malls are being redeveloped into mixed-use complexes that integrate hotels or apartments with retail and dining, transforming once struggling properties into vibrant community hubs and enhancing their long-term value. Real estate investors appear encouraged by these trends. Retail-focused REITs, previously laggards, have seen their stocks stabilize or even rise modestly this year, and some hospitality REITs have issued optimistic guidance based on sustained travel demand. While challenges linger, such as labor shortages in the hospitality sector and the slow repurposing of certain obsolete retail locations, the narrative around brick-and-mortar retail and hotels has shifted from one of doom to one of cautious optimism and new growth opportunities. 10. Policy Spotlight. Governments tackle housing affordability with new initiatives. Confronted with a persistent housing affordability crisis, policymakers at all levels of government are rolling out measures to boost housing supply and ease financial pressures on households. In Washington, the administration unveiled a comprehensive housing affordability agenda earlier this year, which includes proposals to invest billions of dollars in constructing affordable homes, expand down payment assistance for first-time buyers, and incentivize local jurisdictions to relax exclusionary zoning rules. One centerpiece of the federal plan is a reformed low-income housing tax credit, LHC, program that would roughly double the credits available for affordable housing development over the next 5 years. A move expected to spur the creation of hundreds of thousands of below-market-rate rental units nationwide. Additionally, a new competitive housing supply grant program has been proposed. It would reward cities and counties that implement pro-housing land use reforms or streamline their building approvals with federal funding for infrastructure projects that support new development. This approach is meant to marry federal dollars with local action, acknowledging that land use decisions are made at the local level, but often hamstrung by community opposition or outdated regulations. State governments are also actively pursuing housing policy innovations. In New York, lawmakers have debated measures to encourage office-to-residential conversions in Manhattan by offering tax incentives to building owners, a response to the city's high office vacancy and chronic housing shortage. In a different vein, Minnesota recently passed a law overriding local bans on multifamily housing, essentially requiring cities to allow duplexes or small apartment buildings in areas formerly zoned exclusively for single-family homes, following similar models pioneered by Oregon and California. Meanwhile, states like New Jersey and Washington have significantly increased funding for tenant rental assistance and expanded renters' rights to help ease the more immediate financial burdens faced by households. Some cities are also pushing forward with their own initiatives. Seattle, for example, approved new zoning changes to permit greater density near transit stops and is expediting permits for projects that include a high percentage of below-market units, while Chicago launched a pilot program offering vacant city-owned lots for $1 each if developers commit to building affordable homes on them. These varied local efforts share a common goal of lowering barriers to housing production or directly subsidizing affordable homes, illustrating a growing political momentum to address soaring housing costs. The effectiveness of these initiatives will only become clear over time, and they come with their share of debates. Housing advocates generally applaud the array of measures as overdue steps to increase supply and protect vulnerable tenants, though many argue the scale still falls short of what is required. There is also pushback from some communities and interest groups. Zoning reforms and densification efforts often meet resistance from residents worried about neighborhood character or property values, and expanded tenant protections raise concerns among landlords about their ability to manage properties and maintain profitability. Economists tend to support supply-focused strategies, predicting that adding more housing, especially in high-demand regions, should eventually temper price and rent growth by aligning supply closer to demand. But they caution that tangible results will take years to materialize. In the interim, the affordability crisis remains severe. Households in many major cities continue to spend a disproportionate share of income on housing, and homeownership rates among young adults are historically low. Thus, policymakers are balancing long-term structural fixes with short-term relief measures to assist those currently squeezed by high housing costs. The coming year will test whether these new policies can begin to move the needle on affordability and whether the political will exist to pursue even more aggressive changes if needed. Disclaimer: the content above is for informational purposes only and does not constitute legal, financial, medical, or official advice. All news stories and commentary are presented as analysis, not guidance or recommendations. Do not treat any anecdotal accounts as professional advice. Always consult a certified expert before making legal, financial, or health-related decisions. Video description: in this video, we present a deeply researched real estate news report dated May 25, 2026, examining the latest trends and dramatic developments shaking the property market. We cover a record-shattering $69 billion apartment REIT merger, creating the nation's largest rental landlord, and analyze what this consolidation means for the multifamily housing sector. We also explore the spring housing market's surprising rebound, including the return of bidding wars in many cities, and contrast that optimism with ongoing struggles